Hello again and welcome back for another edition of London Direct. The skies above my head are concrete grey, largely because of increased pollution in the city. But is Janet Yellen's Fed policy any more clear? Well, I've been speaking to David Starkey from Cambridge Mercantile. Okay, David, let's drill down into this Fed press statement. Can you tell me the difference between not being patient and not being impatient?
Right. So Yellen very much took with one hand, gave with the other. The word patience was removed from Fed interest rate guidance. However, at the same time, she's lowered expectations for GDP, for inflation, and as such, the trajectory of Fed rates. In December, at the last economic projections, expectations were that Fed rates would be over 1% at the end of 2015. Most recent data has shown the Fed now only expects rates to go as high as 0.625% by the end of 2015. As such, the overall result was dollar negative.
Yeah, so what was she waiting for? Because there's always a reason not to raise rates, right? And she's talking about problems in the Eurozone, problems in China, also citing the low inflation at the moment. There's always going to be an excuse not to raise, right?
It's very much a confidence factor. The United States knows that it can't go it alone. Its economic recovery is still fragile. It needs there to be confidence in the Eurozone, in China, before it can be in a place where it can remove its own monetary policy stimulus. I'm
wondering if all is rosy in the US garden. There's lots of emphasis on this headline jobs figure, which is of course the Fed's mandate. But if you look at US retail sales, for example, they were down for 3 months in a row. You think that would be lower commodity prices, a strong dollar would help the retail sales. But what's going on there?
Certainly, retail sales should be increasing as prices on the shelves drop due to lower commodity and input costs. However, there's a hedging factor. All the companies for whom manufacture these goods, they'll be hedging all of their commodity and FX exposure over time. So that has to work itself out. Expect 6 to 12 months that we would see the impact of that start to hit the shelves. So we get to the summer in the Northern Hemisphere, we could find ourselves in a place where for manufactured goods, the value of lower commodity prices is hitting the end consumer.
Let's talk about the currency implications of all of this. The dollar strength has been a real story in FX markets over the recent months. What does this mean for the dollar?
Outlook for the dollar is still positive. Still set to outperform euro, still set to outperform sterling, Japanese yen. However, the trajectory of that outperformance has come down. Short-term yield differentials are a very big part of FX rates, and those differentials have narrowed following the updated Fed guidance. So what we'll see is US dollar still outperform, but the degree of that outperformance is less.
And what about the euro dollar? I was speaking to lots of people last week and I was asking them where the bottom was. It was slightly unfair because they didn't have a clue. It was dropping so fast. We've got more stability now. Do you think that parity is still on?
Parity is still very much in the cards. However, I suspect that we'll find parity something that we're looking at perhaps once the first interest rate hike in the United States occurs, as opposed to something that happens as a function of panic selling in the euro. So we get to June or perhaps September when the Federal Reserve actually hikes its interest rates, then parity is something to be looking at. But for now, expect sterling dollar to stabilize as markets take stock of what's happened over a very volatile few weeks.
Well, thank you to David for his take on events. Hopefully next time you see me, the weather will be at least a little bit better here in London. But for now, goodbye.